We've been discussing the various steps for auditing the purchasing process. In the last video, we discussed step number 4, evaluating and understanding the design of a company's internal controls. In this video, we're going to move on to step number 5, and we're going to discuss how the auditor would go about testing the effectiveness of the client's internal controls. So how would an auditor go about doing that? Well, the auditor needs to determine two things. Number one, is the internal control operating as it was designed to operate? If a company has an internal control, but it's not actually operating or doing anything, then it has no effect. The second thing the auditor needs to know is if this internal control is being performed by an employee who has both the ability and the authorization to perform the control. Again, so it's critical that you not only have an internal control in place, not just say, oh, we have this written policy or procedure in place, but that the control is actually operating as designed by someone who is competent and authorized to perform the control. Now, how would the auditor specifically go about testing the internal controls? What kind of methods do they have at their disposal? Well, they can inquire of the company's personnel to talk to them about how the internal controls work, but they could also observe the client actually applying the control. They could actually go and watch employees of the client go through the different steps of performing the internal control. They can inspect client documents, see if reconciliations had been performed. The auditor could reperform the control themselves. They could also do a walkthrough that's going to include multiple steps. Okay, so there's a number of different things that they can do. Now, what if the auditor were to find that an internal control is not operating effectively? Well, what that is going to mean is there's going to be a higher risk of material misstatement. Because remember, the risk of material misstatement, RRM, okay, that is a function of inherent risk and control risk. Okay, so if an internal control is not operating effectively, that means a higher risk of material misstatement. If there's a higher risk of material misstatement, then that means that the auditor is going to need to do more substantive procedures, okay, in order to decrease detection risk and keep the audit risk at an acceptable level, okay? So internal controls aren't operating effectively, higher risk of material misstatement, auditor is going to need to perform more substantive procedures. So that's what we're dealing with here. Now, when the auditor is going to perform tests of internal controls, when possible, the auditor would like to perform dual direction tests, okay? What is a dual direction test? So let's do an example, and we'll talk about an example where the auditor's checking to see if the client look for a three-way match of the purchase order, the receiving report, and the invoice from the vendor. Okay, remember that's a very important thing in terms of internal controls, this three-way match. It doesn't guarantee that there was actual legitimate order and so forth, but when you have a purchase order, receiving report, and invoice, that's pretty strong evidence that there was actually a purchase transaction, that the company has a liability. Now, in terms of testing the existence assertion, okay, so that means that does this company actually have a true liability? What the auditor can do is vouch a sample of invoices. Okay, remember the invoice is the bill that the company gets from the vendor. So they vouch those invoices and they go back and say, okay, let's see the supporting documents. There should be a receiving report and there should be a purchase order. Okay, so they're testing to see, is this actually a liability? We've got an invoice, but let's see if there's these supporting documents there. Okay, so that's testing the existence assertion with this three-way match. But you could also go the other way, and that's what we call this dual direction test. Instead of vouching back, so going from the invoice and going back to the supporting documents, we could start, okay, with a sample of purchase orders, okay, and then go forward, trace it forward. Remember, you vouch back and you trace forward. So trace a sample of purchase orders forward to the receiving reports, to entries in the purchases journal. Okay, so that would be testing completeness, because if we take a purchase order and then we go and say, okay, did that lead to a receiving report? Was that ultimately recorded in the purchases journal? Okay, so either way, what we're looking for is this three-way match of the purchase order, receiving report, and the invoice. But one way we're going back, we're vouching back to the supporting documents, and the other way we're starting with the purchasing order the purchase order, and then we're going forward, tracing that forward to see the other documents. Okay, there was a purchase order, but was there then later a receiving report? Okay, and then an invoice and so forth. Okay, so that's what we call a dual direction test, where the auditor is testing backwards, but then also tracing forward. Let's discuss some tests of controls related to purchase transactions. So here's how I've got this set up. This column is a list of management assertions. This column is a list of potential misstatements. This column is a list of internal controls that the company might implement. And then this column here is a list of tests that the auditor could do of the internal controls to see if they're operating effectively. Okay, so we'll go through a few of these, and we'll start with the management assertion occurrence. So what is the concern here? Well, the concern is the auditor is worried that some of the purchases might be from fictitious vendors. Okay, remember that we could have an employee that could steal purchase orders, receiving reports, forge them, set up a fake company, send an invoice to the company, and so then the company is paying some fictitious vendor. So the purchase is not actually a real purchase of the company. So the company could set up a number of internal controls. For example, they should be using pre-numbered documents, pre-numbered purchase orders, pre-numbered receiving reports. Now, what can the auditor do? Well, just because the company is using pre-numbered documents doesn't mean that internal control is operating effectively. Why? Because the client should be going and checking if there are any numbers out of sequence. Okay, if they're missing a certain receiving report, for example. So just because you're using pre-numbered documents doesn't mean that the internal control is actually working. So what the auditor could do is verify that the client's employees are actually going and checking for missing numbers in the sequence. So for example, if they look at the receiving reports and they're using pre-numbered documents, the auditor could say, okay, which of the employees is responsible for going and checking that there's no missing numbers in the sequence of receiving reports. Okay, so that's how the auditor would go about testing the effectiveness of this control. Now, when it comes to completeness, the concern is that liabilities might be understated. Okay, so the company made a purchase, but it didn't actually record it. So in terms of testing the controls, so the client should be matching receiving reports to vendor invoices. But what the auditor could do is say, okay, let's go and trace some purchase orders. Let's trace them forward to the receiving report, to the voucher, okay, and then trace it forward to the purchases journal. What are we testing here? Again, completeness. We want to make sure that there wasn't a purchase that was made, but it was never recorded. So if we go back to the purchase order and we trace it forward to see if it was actually later recorded in the purchases journal. So this would be what the auditor is doing. Okay. Now, in terms of the authorization assertion, concern is from the auditor that purchases might not have actually been approved. Okay, maybe somebody at the company made a purchase, but this wasn't an approved person that could have made the purchase or something like that. Okay, so there's only certain people that are supposed to be making purchases, and there's usually limits. So for example, they might say lower level managers can't make a purchase of more than $1,000 and so forth. So the auditor could go and see, okay, for example, if you have these limits in place, they could just go and check and see, well, were lower level managers able to make any purchases for over $1,000? Another thing is that purchases should only be allowed from an approved list of vendors. Okay, that's again to prevent this thing when I talk about fictitious vendors. So every company should have an approved list of vendors, and they can only make purchases from that approved list. Okay, so what the company or what the auditor could do to check to make sure that the company is actually using this internal control, right? Because it's one thing for the company to say, look, we have an approved list of vendors, we only allow purchases from that approved list. But again, the auditor wants to know, is that control operating effectively? Are they actually doing that? So the auditor could go and take some purchase orders and then go and say, all right, let's look at a sample of these purchase orders, and let's see if the vendors that they're buying from are actually all from the approved vendor list. And so if the auditor goes and looks at a sample of purchase orders and finds that, oh, half of them, the purchases are from vendors who aren't even on the approved vendor list, then that suggests that this internal control is not operating effectively. Okay, now, Just accuracy assertion. We'll discuss that. What is the concern here? For example, the company might have overpaid the vendor. So what could the auditor do? Well, the company should be verifying the mathematical accuracy before they're approving the vouchers for payment. So the auditor could go select a sample of vouchers, for example, recalculate what the prices are, make sure to take into consideration the applicable discounts, and verify that actually the correct price was paid. Now, in terms of the cutoff assertion, the concern is that liabilities might be postponed, right? That the company is basically not wanting to record a purchase in the current period because there'll be an associated liability with it. So they want to postpone it till the next period. So what can the auditor do? Well, the company is supposed to be forwarding receiving reports to the accounts payable department on a daily basis. Why? Because remember, when the company actually receives the goods, that's when they technically incur the liability, right? So if these receiving reports are sent to accounts payable on a daily basis, then hopefully the liabilities will be recorded in a timely manner. But sometimes they would delay this, right? Because they don't want to record the liability. Maybe management is being dishonest. So what the auditor would go and do, compare the dates from the receiving reports with the dates from other documents, the vouchers and so forth, okay? So they want to compare the dates and see, well, was this actually postponed? Okay. Now, in terms of classification, the concern is, so when you're buying something, okay, you're buying something. So you've got something that could be recorded as an asset or could be recorded as an expense. And we've had a lot of frauds, like for example, WorldCom, where they were improperly categorizing something as an asset when it should have just been expensed immediately and not capitalized. So you want to watch for improper categorization, improperly capitalizing things that should have been expensed as just a routine expense. So what can the auditor do? Check vouchers and look at the account codes and see, okay, was this properly classified? Maybe this should have been an expense when it was categorized as an asset. Now, so that's a list of assertions, internal controls, and auditors' tests of controls for purchase transactions. So next, we're going to discuss cash disbursement transactions, okay? Again, I've got the same setup. We've got the management assertions here, potential misstatements, internal controls the company could implement, and then how the auditor would go about testing those internal controls. So we'll start with occurrence. What is the concern here? Well, maybe there was a disbursement that was recorded. So they recorded, oh yeah, we paid out cash, but the vendor didn't actually get the money. So what does that mean if we said, well, we recorded this, but the vendor didn't get the money? Well, maybe an employee stole the check, right? So they recorded that, yeah, we paid this vendor, but the employee stole the check, so the vendor never got paid. So what could, so the company should be reconciling the statements that they get from the vendor, right? The vendor is going to give them a bill every month, and they should be checking that against their own accounts payable records. They should be doing reconciliations and so forth. And the auditor can verify that the company is actually doing these reconciliations, that they're actually comparing the vendor statements to the company's own account payable records. So the auditor can verify that they are doing this. Now, when it comes to completeness, we've got a thing of cash disbursement made, but then not being recorded. Well, how would it be that the company disbursed cash, but then there was no record of the cash? Well, maybe an employee just stole some cash. Maybe they dispersed cash to themselves and they didn't record it because they didn't want anybody to ask questions about it. So how will we avoid things like that? Well, again, segregation of duties is a very important internal control when it comes to the purchasing process. And then what the auditor could do is observe the client's personnel and check to see, okay, who is responsible for X? Who is responsible for Y? And verify that the duties actually have been segregated. Now, when it comes to the authorization assertion, a potential issue, an employee just writes a check to himself, okay? And that hasn't been authorized or anything, right? So, now, the company should be verifying source documents before they issue a check, right? They shouldn't just be issuing check without any kind of supporting documentation. And so what the auditor can do in terms of tests of control, determine whether the client's personnel are actually requiring source documents before they issue a check. Again, just because the company says, yeah, we have in writing that our policy is that before we issue a check, there should be supporting documents there. It might be that in practice, the company doesn't follow that control. So the auditor's job is to go and test that control and see, in fact, is a client, are their employees going and verifying any supporting documents before they would go and issue a check. Now, when it comes to accuracy, again, we have a potential issue would be the company overpaid. Maybe they paid more cash, they dispersed more cash than what they should have. This comes down to reconciliations. So the reconciling cash disbursements to the checks issued, reconciling the vendor statements to the account payable records. And so what the auditor can do is just review the reconciliations that have been performed. Maybe the client isn't performing any reconciliations at all. So the auditor needs to obtain some evidence that the client is actually doing these reconciliations. When it comes to cutoff, the concern is cash was dispersed in the wrong period. Reviewing any reconciliations that were done by the client. When it comes to classification, issue with maybe a cash disbursement was charged to the wrong account. So what can the auditor do? Well, the client in theory should be using a chart of accounts and reviewing that chart of accounts when you think about which accounts get charged with a cash disbursement. So the auditor could go look at the voucher packet, review the account code, check that against the chart of accounts and see if the cash disbursement is being charged to the correct accounts. Now, here's a list of, now we're talking about accounts payable balances. We did purchase transactions, we did cash disbursement transactions. Now accounts payable balances. Here's a list of assertions, potential misstatements, internal controls that the client could have, and then a list of ways that the auditor go about testing the operating effectiveness of those internal controls. I'm not going to go through all these because you can see them. I think I give you enough examples. Now, when it's all said and done, after the tests of controls have been completed, then the auditor needs to set the achieved level of control risk. Remember that the auditor had a planned level of control risk. They had an idea of what they thought the control risk would be, but then they go and they test the internal controls. And they might find that, you know what, actually these internal controls are a lot weaker than what we thought. Maybe the client told us all this great stuff about their internal controls, and we found that most internal controls are not operating effectively. Okay, so if the achieved level of control risk is higher than what the auditor had expected, okay, then that means the risk of material misstatement is going to go up. The auditor, to bring down detection risk and keep audit risk at an acceptable level, the auditor is going to have to perform additional substantive procedures. Now, if it went the other way, if it turns out, you know what, the achieved level of control risk, actually, this client's internal controls are operating a lot more effectively than what we had thought, then the auditor could actually say, well, you know what, actually, to make the audit more efficient, we could actually do fewer substantive procedures.